Welcome back to Trade and Wait, where we're going to analyze price action on the ES utilizing ICT concepts. And what is on the menu today is the same thing every day from now on, which is I'm going to focus on the 4-hour, 1 hour, or the 15 and 5 minute as the lower time frame charts or the trading time frame charts. And I would just want to, I don't think it's clarification, but one nuance that I wanted to shed some light on is that even though we are utilizing the 4-hour time frame as a higher time frame chart and not necessarily trading in the direction of the daily bias, but seeking out liquidity in some shape, form, or fashion. So yes, that's the plan. And also, if the 4-hour chart is not clear, then we move down to the 1 hour and look for setups there. That's one caveat. If your rule is, hey, I'm only looking for setups on the 4-hour chart, if it's not clear to me, I'm not trading at all, that's perfectly fine. If your high time frame chart as a scalper is a 15-minute, that's fine as well. If your high time frame chart again is the 1 hour, that's also fine as well. Whatever you decide to do. I'm not really into any types of fads or trends, so I don't look to trade the 15-second, none of that stuff. And if I could avoid it, I am not trying to trade on the 1 minute, even though the principles are still the same. So here we go. And again, this is the focus. If you treat the 4-hour or the 60-minute as your daily chart and study 5-minute structure, a whole new world opens to you. Test it and see. And also the 15-minute chart removes the blur. So if things aren't clear, 4-hour, 60-minute, then looks like it's scalping time, right? So to speak. For me, if I use a higher time frame chart, the 15-minute as that higher time frame chart, I am definitely going to be a scalper at that time. unless I'm utilizing the 15-minute chart to literally trade on, which in that case is not the higher time frame chart, it's like the trading time frame or the lower time frame chart or the short term, whatever you want to consider it. So it's typically, as this signifies, it's that 4-hour is a high time frame, 1 hour is the intermediate, and 15-minute is the short-term time frame, aka the trading time frame. But depending on your style of trading, any one of these can be where you decide to pull the trigger. One thing that Alexander Elder, Dr. Alexander Elder, author of New Trading for a Living, and what he mentions is that you shouldn't move to the intermediate time frame until you have analyzed the higher time frame chart. So, right, that kind of like keeps you to some degree out of harm's way. These are from the previous days. I'm gonna leave that there, even though they're not relevant right now because today is Tuesday. But one thing I wanted to point out is that this is the 4-hour chart and this is the 1-hour chart. And why is that necessary to point out instead of just jumping right down into the time frames that I'm most comfortable with, is that on the 4-hour chart we have a order block. Now, an order block here that price traded into here. This candle is 2200 candle on May 12th, which is Monday. 2200, like here, 2200 to 200 the next day. So that's all of this. 1, 2, 3, 4. Right, that's an order block on this time frame on the 4-hour. Right, so this is where it comes in at, right? Let's say you don't know what an order block is, for example. But you don't know that, hey, down close candles are supposed to support price higher once price trades into it. Let's say that's not your style. Then that means that this pullback may not have been clear to you, depending on maybe you're utilizing some other tool or strategy. because you do have a internal range liquidity. You do have external range liquidity targeting this swing high. Then you have a pullback back into internal range liquidity. Doesn't have to be a fair value gap. Doesn't have to be a fair value gap. Internal range liquidity could be a number of PD arrays. In this case, it's an order block on a 4-hour chart. However, on the 1-hour chart, it's a fair value gap at that near or around that same level. That's what I mean. So if this 4-hour chart is not clear to you because of your style of trading, then either don't consider the trade or consider a different time frame, right? And in general, depending on your style of trading, depending on your rules of engagement, then that may mean that you may be willing to hold a trade, less likely to hold the trade longer because of the 1-hour time frame. However, again, well, not again, but you want to always consider price action in comparison to the past, at a minimum, the past previous 3 days. In this case, this is the previous day's high. Turn that blue, drop that down to 1. All right, so again, 4-hour order block is a 1-hour. In comparison, is a 1-hour fair value gap, and you can see, let's restrict that to the 4-hour. All right, so that's solid. But here on a 1-hour, good money. Good. Actually, is a, if you saw that it's as a balanced price range, then I wouldn't blame you, right? Because you have a displacement lower, and there's a small fair value gap here on the 0900 hour Monday, May 12th candle. I'm gonna put it on there and then take it back off just for observation. All right, and is that like, so you may say, oh, that's not relevant because, all right, let's see how that's the price of the low of this candle, of the 0800 May 12th candle, 58.45, and we have this swing low here, 58.45. And all right, you may not see that as significant. You may say, oh, that's here, you're teleporting way over there, that's random. Who cares? So long as you can make money from it. I'm not into noise, making noise for no reason. So this one, all right, so boom, right? So this, you can see that this as a inverted fair value gap, bearish fair value gap, or you can see price holding this bullish fair value gap above consequent encroachment and trading above the high of that fair value, bullish fair value gap, and then using it as support here. Same situation. And you can always say in this situation that the bodies tell the story and the wicks do the damage, because that's what that is here. The wicks went down and the bodies, both of these 0600 hours and the 0700 hour candles, both stayed above the high. The body stayed above the high of that fair value gap. So all depends how you see it. Fair value gap bullish, inverted bearish fair value gap, or a balanced price range. All right, that again, so if these aren't your PD arrays, then don't worry about it. If you don't see your trade clearly, then just don't take it, man. What do you like? I get it. I'm not insulting anyone, because I definitely made some poor decisions in the market while I was learning. And even now, you can still be susceptible to poor decision making. That is never off the table. So there that go. So this is the 1-hour chart, and then all right. So let's flip this, and we got to take that off because that's a 1-hour level, and we can leave that here. And I want to go to, let's leave this accessible to all of the lower time frames, and then we can go to the 15 and then the 5. This is the 15 and then the 5 over here. Let's see what we can do. See what we can do. Oh, that's the next thing, right? Because we highlighted this inverted fair value gap yesterday. But guess what? Price literally returned back into that inverted fair value gap and quite frankly stayed above the consequent encroachment of it, consolidated above it, and then traded higher from there. So that's the level that we identified yesterday, and the 50% mark is literally right here, and price traded through it into an imbalance, into a bullish fair value gap on the 5-minute, and proceeded to go higher. All right, that's neither here nor there. So I kind of want to just take that off for now. The point for that is proven. And these are this green one is the 4-hour order block, and these are the 1-hour levels. This is the 15-minute chart. This is the 5. And we're looking for setups for today. So if you're not up during the London session, then this trade, this run up was not for you, right? All right. All right, we already kind of discussed this already. And how come? So, bam. So what do you see here? Let's take off the drawings for now, and this is what we've been toying around with, right? So here, this is yesterday. We kind of discussed this already. Price ran this low. Then you got a break in market structure here with this swing high on the what's this? This is the 1400 to 1800 hour candle, and of course, cost 1700 to 1800 market is closed during that time, so that's why you see this little bit of daylight in between this these colors. Anyway, we discussed this. Run on stops is your break in market structure here. We didn't discuss that, so it ran this 0600 hour 4-hour candle and then pull back, taking out low and pulling back into the range of this 10 o'clock candle, 10 o'clock to 2 p.m. candle, and then pushing higher. And you can see here, let's see what that looks like. It looks so colorful, like looks like something to stay away from, like all these colors, right? What is this? I don't care. This is some of the stuff you're doing here in these reviews. It's not necessarily something you would do while you are actively in the market, but you need to have that type of foresight, right? When you flick it on, you flick it back off, depending on what you're waiting to see. You run on stops, that's part of your system. Run on stops and look for a break in market structure and proceed from there. Then that's, or either a market structure shift or a change in the state of delivery. That's perfectly fine, right? Anyway, you could always delineate these highs and lows on your own separately. All right, so we have this range running stops on this PM session lows, and then the Asia session kind of, this is the London session, sorry, London session consolidated. Oh, we are at 14 minutes. Let me wrap this up. Sorry, I don't know where the time went. Time flies when you're having fun, right? Anyway, run on stops here on this time frame, on this 8-hour candle or 4-hour candle. From here to here would be this candle. So ran the low, then consolidated. So this ran the low too, that on this 500-hour candle, it ran these lows, the 315 and the 4 o'clock low, relative equal lows. It didn't run this low. It also traded into this fair value gap. And that would be highlighted here. Anyway, too many colors, too much noise. It's disturbing me. Let's see. All right, so we see this stop run, and we see a consolidation and a manipulation leg here. And take this off. And then we were targeting here, and obviously this went outside of the range, continue higher. This would be these relative equal highs, then these relative equal highs. And now we are in like this balance price range here on the 4-hour chart. Let's see what that will. Let's just shoot a line across here. All right, so got an inverted fair value gap and a bearish fair value gap here. So it's pretty much the same high. So let's change that to, change this one to black, make it thinner, black, and change this black and thinner. I don't know what I take, 2, 3, 3, black. This is just for observational purposes. So look, hit that, hit that. Oh, it didn't hit the high. Bodies are staying. Bodies kind of like went above this low of this inverted fair value gap, and the bodies didn't drop back down. Only time will tell. Time will tell. Let's take that off because that's noise too. All right. Boom. Right. So let's clear all of this. I wrap this up in about 3 minutes. 3 minutes. All right, so we already identified we have key support and resistance. This right here is the previous day's high. So that's significant. I'm just gonna see the 4-hour up, previous day's high, and this is where we are. You wanted to highlight this bullish fair value gap, you could have, but let's just wrap this up. 4-hour chart, got an order block, previous day's high, and let's get cooking, right? So in the, this is the 9:30 opening price right here. But what do you have prior to that? We have news, CPI news. Price ran up above the previous day's high. Came back down, closed here, opened, ran back up, tested it, dropped. There's no market structure shift. There's no change in the state of delivery. So guess what? We can continue with that bullish ideal. I overshot the order block because this is a volume imbalance, and we want to include that when we have this type of situation going. A fair value gap plus a volume imbalance together, you want to just group them together. So here you go. That's your entry. This is it. This is to push higher and continues running higher and then drops down. So this fair value gap here is significant as well. Why is it significant? Because you see price traded into it here, and then price pushed up, use it as support. So what that makes it, in any other case, you'll call that a key support and resistance level or an inflection point. And so we had this run, we had the 1, 2, 3 drives pattern. 1, 2, 3. Then you have the drop lower, break, breaking market structure or market structure shift. And why do I like this swing low? It's because this imbalance is here, and we dropped, kind of traded into this tiny little fair value gap on the 1350 hour candle. Drop lower, so we got an relative equal lows here. Price traded back up, right? It failed to take out this swing low, so it ran back up. Upward consolidation here, or bear flag here. Took out this swing high, drop, breaking market structure, immediate rebalance of this price range. That's a key indication that price wants to continue lower. So that's another PDRA, immediate rebalance of a price range, right? Because if this candle opened up here and this wick didn't trade into this gap, into this low of the previous candle, then in this middle candle would have been a fair value gap, right? And in this case, it's immediate rebalancing, but it's also traded into this inverted fair value gap. So that's a reason to go lower here and targeting these swing lows. And then this again, because it was previously support and resistance, then it's a high probability that it will still be to some degree support, unless you had a catalyst that just rush price down lower. And this was at 1600, and then it consolidated up into now, which is 7:30 p.m. 1930 hours, 1931 hours. All right, so I think that's a clear trade there. All right, we were discussing this trade here. Ran low, no break in market structure or market structure shift, consolidated. So it depends how you see that. And based on time and price, we can kind of anticipate higher prices, right? So here we have a swing high at 0850 hours, and we have a small fair value gap on the 0840 hour candle. I'm calling these like numbers out, like, oh, so you got a small fair value gap here, ever so tiny, with prices respecting, bodies held a story, and the wicks do the damage. If you didn't see that tiny fair value gap, you could have used this reclaim bullish fair value gap. Let's just draw that out, then delete it, because all right, so let's delete that tiny one, and you can still see that price respected this inverted reclaim bullish fair value gap in respect to consequent encroachment of it. So that's a reason to go higher. Then you have a breakaway gap. Price traded above the previous day's high, broke above it, retested it, and proceeded higher from there. And then you have, we discussed this part, so you can stay out of that. But that's also an optimal trade entry. Let's see. Ideally, you want to put it where the most dynamic price action was. And you can easily say it's here and here. It's a 5-minute chart. So we have a nice setup here on a 68 point. Anyway, optimal trade entry anywhere between 61.8 and 78.6, anywhere in this range. So we got a nice steep discount. Also, let's say from what we discussed in the past, myself, when you have these long wicks, I tend to not use those long wicks, and I just use the body of the candle. So this one is a short wick, I'll leave it. You don't have to, you can use the low and you still have 78.6, but that's going to shift. Obviously that shifted your risk to reward based on your entry. Your stop loss is a little bit higher. I wouldn't actually leave the stop loss here, but anyway, it's a little bit tighter entry. It shifted your standard deviation. So for today, that's probably going to be 6 or 7 standard deviations. Where's 5? This is it's all like jumbled up. All right, so 5, 6 is up there. So you got 4, 5, 5, almost 5. Oh, matter of fact, 5 is 59.27. The high of this candle is 59.27. You can see right here, 59.27. So that's 5 standard deviations based off of the range that we utilize to gain entry. So standard deviations is great when you, for me, for targeting, as well as you want to think in terms of R, right? You got in between 61.8, let's say. You wanted to make sure you got in 61.8. Let's see what that will look like. 61.8. And your stop loss would have been below this down close candle. And so just targeting 2 standard deviations would be almost 6, 1 to 6, 1 to 6. So, right, could have got out there, that's fine. And this pullback is at 1040, 1040. Then we got another break in market structure here, and a retracement into an order block or a propulsion block, whichever one you want to choose. Or did it pull all the way back? It didn't pull all the way back, but there's your, this should be another option trade entry long. Let's see if that's valid. But anyway, if you took it all the way up to 5, that's 12, 1 to 12, 12.45. That's pretty decent. That's more, that's a lot. That's pretty good. See how many, that's pretty good in terms of a day trade. And how long would that have taken you? You could have gotten here. Stop loss is still the same. That's 8:45. Or you could have waited 9:30. False run lower and taken out sell stops, and then proceeding higher. In the moment you lost momentum, you could have exited the trade or shaved, took off the bulk of your position, depending on how you trade. All right, bam, right? Let's delete that. And I think I said, I don't know how long ago it was 3 minutes, but I'm just like 27 minutes in. So we have another entry. I think I pointed this type of thing out when we have like stab down and break in like a fair value gap. So we have the retest here and then price shot. Check that out. Let's say you didn't see that, and then you could have got in here. Let's see if that's an optimal trade entry as well. It is, bam, right? 61.8. It's not if you don't use the wicks, in which case the principle still applies, which is what's the motto? Run on stops. Rule number 1, run on stops. Second rule is market structure shift, and then a retracement below 50% of the range that caused the market structure shift. And in this case, there's a small volume imbalance between the 1050 candle and the 1055 candle. And that looks like what kind of held price higher. Bada bing, bada boom. Right? Right, so bam, then we got a pullback. Right, pull back into this. Again, the bodies tell the story, the wicks do the damage, and then it pulled higher. What is this here? All right, boom, boom, retracement, long. And actually, if you didn't see that, then you could have did this as well, but then you would have to use the wick though. So not like a big and ugly wick like this one, but still long, right? May not have considered that. All right, that's all I got, I believe. Thank you for listening and chiming in. Please like, comment, subscribe. Peace.